thousands of UK crypto holders could soon face fines or even jail thanks to a sweeping set of new tax rules due to come into force in January 2026. And here's the shocking part, it doesn't matter if you haven't cashed out into pounds, even swapping one token for another could land you with a tax bill. Today we're breaking down exactly what HMRC is changing, why these rules are causing alarm across the crypto community, and most importantly, what you can do to protect yourself before the crackdown comes into force. So let's start with the basics. HMRC, or His Majesty's Revenue and Customs, is the UK's tax authority. For years they've struggled to properly trace and track crypto activity. People have bought Bitcoin, traded altcoins, staked tokens, and all with very little oversight. But now that's changing because from January 2026, HMRC is introducing tougher rules on reporting and taxation of crypto transactions. And this isn't just about big traders. Everyday users, so people who casually gift or spend crypto, will now fall under the radar of HMRC. So what actually triggers a tax bill? Well, according to the new guidance, HMRC will treat crypto like a capital asset, which means that capital gains tax applies whenever you dispose of crypto in one of the following ways. Trading one crypto for another, for example, swapping Bitcoin into Ethereum. Selling crypto for fiat, which seems like an obvious one, and is essentially cashing out your crypto into pounds. Using crypto to buy goods or services, and even buying a coffee with crypto could become a taxable event. Even gifting crypto to someone other than your spouse or giving tokens away counts as disposal. Now, the good news is that just holding crypto, i.e. keeping it in your wallet or on an exchange, doesn't create a taxable event. But the moment you make a move, HMRC is going to want a cut. So let's break this down with some quick examples. Imagine you bought £2,000 worth of Ethereum last year and it's now worth £4,000. If you sell, you've made a £2,000 gain, and that is now potentially taxable. But here's the part that a lot of people miss. Because let's say you don't sell, you just trade that Ethereum for Solana. HMRC still sees that as disposal. So even though you never cashed out your Ethereum into pounds, you've technically disposed of one asset and acquired another. Or here's another example. Let's say that you gift £1,000 worth of Bitcoin to your best mate. Even though you made no money from that gift, HMRC could still apply tax rules to it. So this is why record keeping is absolutely essential. So how much can you actually make tax-free? Well, the annual capital gains tax allowance in the UK is £3,000. This means that if your gains in a total tax year are below that threshold, you won't owe any tax. And there's a problem here because that allowance used to be a lot higher. A couple of years ago it was £12,300, it was then slashed to £6,000, and now it's down to just £3,000. So that's a massive reduction. And with crypto markets heating up, it doesn't take much for an average trader to blow past that £3,000 threshold. And even if you're under the allowance, you still have to report your activity. And that's the part that many people forget, because HMRC still wants visibility. Now, you might be wondering, how is HMRC going to be enforcing all this? Well, in the past, enforcement was patchy, but HMRC has now partnered with major exchanges like Coinbase, Binance and others that all operate in the UK, and they are sharing customer data directly with the tax authorities. And on top of that, HMRC analysts are using blockchain forensics tools to trace wallet activity. So if you thought you could move tokens around anonymously, think again. And this means that anyone failing to report accurately could face steep fines, audits, or in extreme cases, prosecution. Now, one of the more interesting parts to all this is that not all crypto is taxed under capital gains tax. Some of it actually falls under income tax instead. And according to Lee Murphy, who is the managing director at the Accountancy Partnership, if you are paid in crypto, for example, as part of your salary, then HMRC sees that as income. If you are earning crypto through staking rewards or mining, then HMRC also treats that as income. Now, this can sometimes work in your favour because in the UK, the first £12,570 of income is tax-free. So if you earn only a small amount in, say, staking rewards, you might avoid paying tax entirely. But remember that £12,500 allowance includes all your income, not just crypto. So if you already earn a salary, then that just gets added on top. So why is this such a big deal? Well, for one, the rules are being introduced at a time when crypto adoption in the UK is rising and more people are experimenting with digital assets, from Bitcoin to meme coins to NFTs. And second, HMRC's approach shows the government's attitude. While politicians talk about making the UK a crypto hub, the tax rules tell a different story. Stricter enforcement, reduced allowances, and bigger penalties. It's also worth noting that the UK isn't alone here, because across Europe, new regulations under MiCA are reshaping the industry. Globally, the US is also ramping up enforcement. So these changes are part of a wider trend, and that is that governments want their share of the crypto pie. So what should UK crypto holders be doing right now before January 2026 arrives? Well, keep detailed records. Every trade, every swap, every gift, log it. And there are even now crypto tax apps that can help automate this. Also, know your thresholds. Be aware of the £3,000 capital gains tax allowance and also how close you are to it. Understand income rules. If you are staking or you're being paid in crypto, remember that that's income tax and not CGT. Also plan ahead. If you've got big gains, think about how and when you are going to realise them, because spreading disposals across tax years can sometimes help. And also, of course, seek advice if there's anything that you're not sure of, and especially if your portfolio is significant, and talk to an accountant that actually understands crypto. And the key here is preparation, because HMRC is not giving much room for error. So what do you think? Are these rules fair and necessary, or are they just another way for the UK government to squeeze ordinary people trying to build wealth through crypto? Drop your thoughts in the comments. I'd love to hear your perspective. And if you found this video useful, don't forget to like, hit subscribe and turn on the notification bell. I'll be covering all the latest updates on UK and EU crypto regulation so that you stay one step ahead. Thanks for watching, thanks for listening, and I'll see you in the next one.